Welcome back, everyone. This week, we're diving deep into Australian fixed income markets.
Sounds exciting.
It is, especially with all the recent activity, and to help us navigate these waters, we'll be looking at Gilt Investments' weekly Edge report.
Always a great resource.
Absolutely. And they've really highlighted some fascinating developments this week, starting with the Reserve Bank of Australia's surprise rate cut.
Oh yeah, that was a big one, the first in 4 years.
Definitely caught the market off guard, didn't it?
For sure. Especially with inflation setting such mixed signals.
Right, because on one hand, headline inflation seems to be cooling down. It's down to 2.4%. But then there's the trimmed mean inflation, which is the RBA's preferred measure, and that's still stubbornly high at 3.2%.
Well above their target range.
Exactly. So it makes you wonder, what's the real story here? Did the RBA give in to pressure, or are they truly confident about inflation going forward?
Well, the weekly Edge report really digs into this. It suggests the RBA might be anticipating that inflation will continue to fall.
Kind of like taking a gamble.
In a way, yes, there's definitely some skepticism in the market about whether this was the right move and all this uncertainty. Well, it's making fixed income investing right now particularly interesting.
So this rate cut wasn't just some theoretical exercise.
Oh, no, not at all.
It actually had a tangible impact, didn't it?
Absolutely. Gilt Investments highlights how the Australian yield curve has actually steepened because of the cut.
Okay, so for those of us who don't spend all day thinking about yield curves, what does that actually mean? Can you break it down a bit?
Of course, essentially what we're seeing is that short-term rates have dropped, which reflects this easing.
Makes sense.
But longer-term bond yields, those have remained relatively stable, which is interesting.
It is interesting. So how does all this play out for different types of bonds?
Well, let's take Australian government bonds, for example. AGBs for short.
The classic.
Exactly. Their yields have dipped, which is a sign that investors are seeking safety, maybe anticipating further easing.
Flocking to the tried and true.
Exactly. Then you have corporate bonds. These have seen something called spread compression.
Meaning?
The difference between their yields and those of government bonds has narrowed, so they become a bit more appealing.
Especially if those companies have strong credit ratings.
Exactly. Their borrowing costs become more favorable. So yeah, there's a definite ripple effect across the fixed income landscape.
A lot to unpack there. But before we jump into Gilt Investments' specific recommendations, let's take a step back and look at the bigger picture. The weekly Edge report also points to some pretty significant global events that could impact the Australian market.
Oh, absolutely. The global context is always crucial. And right now we're seeing rising geopolitical tensions and trade wars, which add a whole other layer of complexity.
Yeah, the report specifically mentions Trump's escalating trade wars. That's got to be a worry for Australian exporters, right?
It is. The report even highlights how the CEO of BlueScope Steel is actively lobbying U.S. lawmakers for tariff exemptions.
Wow, that shows you how real these concerns are.
Absolutely. And it's not just about trade either. The situation in Ukraine adds another dimension of geopolitical risk, with Macron pushing back against Trump's proposed deal with Russia. And then you have that ethically questionable proposal from the U.S. to take half of Ukraine's natural resource revenue in exchange for military aid.
It's a lot of uncertainty adding fuel to the fire.
Exactly. And all this is happening as commodity markets are going through a period of volatility, which the report also flags as a potential driver of inflation.
So we've got this complex interplay of the RBA rate cut, global uncertainty, and volatile commodity markets. Sounds like a tricky environment to navigate.
It definitely demands careful consideration and a strategic approach, which thankfully is where Gilt Investments comes in.
Perfect. Let's dive into their recommendations.
Well, Gilt Investments is putting their money on Australian government bonds right now, AGBs.
Makes sense given the rate cut.
Exactly. Short-term AGBs, specifically a maturities of 1 to 3 years, for investors who want to lock in those yields before any further potential cuts, just in case.
Playing it safe.
Exactly. And for those with a longer-term view, they recommend looking at longer-term AGBs, 5 to 10 years out. Those could see some capital appreciation if rates keep going down.
So AGBs are the foundation, the solid ground. But what about those of us looking for a bit more excitement, a little more oomph in our portfolio?
Well, Gilt Investments believes corporate bonds are where it's at right now. They see a lot of potential there.
Any particular sectors they're excited about?
They're particularly bullish on renewable energy.
Interesting. Why is that?
Well, companies in this space are seeing huge growth, and their bonds offer yields that are significantly higher than you'd get with comparable government bonds. So it's a bit of a sweet spot.
A bit more risk, but potentially a lot more reward.
Exactly. And it's not just about chasing yield, right? It's about understanding the underlying trends that are driving value.
Right, looking at the bigger picture.
Precisely. And Gilt Investments also likes major bank bonds in this environment.
The Aussie banks are pretty solid, right?
They are very stable. So Gilt sees these bonds as a good fixed income option with decent yields, a nice balance between safety and return.
So we've got AGBs for stability, renewable energy for growth potential, and major bank bonds for a bit of both. Sounds like a good mix, but what about inflation? How do we protect ourselves from that eating away at our returns?
That's a great question. And Gilt Investments has some specific recommendations for dealing with inflation. First off, they're big fans of inflation-linked bonds, or ILBs for short.
Those are the ones where the coupon payments adjust with inflation.
Exactly, so they provide a hedge against rising prices.
Smart. Anything else?
They also suggest looking into floating rate notes, or FRNs. These are bonds where the interest rate fluctuates.
So if interest rates rise because of inflation, you're protected.
Exactly. The rate typically moves in line with a benchmark rate, so you're not stuck with a fixed rate that gets eroded by inflation.
That makes sense. So we've covered a lot of ground, from AGBs to corporate bonds, major bank bonds, and even ways to protect against inflation with ILBs and FRNs. Anything else investors should keep in mind in this environment?
Well, Gilt Investments emphasizes the importance of diversification, especially now with all this global uncertainty.
Don't put all your eggs in one basket, as they say.
Exactly. They recommend spreading your fixed income investments across different asset classes, different types of credit, just to create a more balanced and resilient portfolio.
So what kinds of credit are they suggesting?
They like state and semi-government bonds. Those offer a decent blend of safety and yield.
Solid choices.
Yeah, and they also highlight something called supranational bonds.
Supranational bonds. I'm not sure I'm familiar with those.
They're bonds issued by international institutions like the Asian Development Bank, for example.
So you get exposure to global fixed income markets, but with a lower risk profile.
Right. And for investors who are feeling a bit more adventurous, a little more comfortable with risks.
The risk takers out there,
Exactly. Gilt Investments suggests exploring select high-yield bonds.
those come with higher returns, but obviously higher risk as well.
Exactly. They do caution that careful due diligence is essential.
Of course. So we've covered a lot of ground here, from the RBA rate cut to global uncertainty, commodity market volatility, and now Gilt Investments' recommended strategies. A lot to process.
It is a lot, but that's where Gilt Investments really shines. They take all this complex information and they break it down into actionable insights. They help you make sense of it all.
They're the experts. That's what they do.
Exactly. And their analysis is top-notch. They're not afraid to make bold calls like with the renewable energy bonds, but it's all backed by solid research.
And I think what's really valuable is that they don't just offer generic advice. It's all tailored to the individual investor.
Absolutely. They understand that everyone has different goals, different risk tolerances, and they adapt their approach accordingly. That personal touch makes a big difference.
So for those of our listeners who are ready to really explore the opportunities in Australian fixed income, Gilt Investments seems like a great place to start.
I definitely agree. Their commitment to transparency, their in-depth knowledge, and their personalized approach, they really stand out.
This deep dive has certainly been eye-opening. We've learned a lot, from macro trends to specific investment strategies. What are your key takeaways from the Weekly Edge report? For me, it's how Gilt Investments really cuts through all the noise and makes things clear. They don't just tell you what's happening, they explain why it matters and how you can actually use that information to your advantage.
Exactly. That's what makes them so good. They take all this complicated stuff and turn it into something you can actually use. Their recommendations are based on solid research, and they're not afraid to take a stand, like with those renewable energy bonds.
Yeah, I like that. It's good to hear experts making bold predictions when they have good reasons for it. But you mentioned earlier that fixed income investing, especially now, it's not something you can just set and forget.
Definitely not. It requires active management. And that's another thing that sets Gilt Investments apart. They provide ongoing support and guidance so you can adapt as the market changes.
You're not just left on your own to figure it out.
Exactly. They get that every investor is different, with their own goals and their own comfort level with risk. So they tailor their approach to each person.
Sounds like they're really focused on building those relationships.
They are. And it shows. So for our listeners who are ready to dive into Australian fixed income Gilt Investments, seems like the perfect partner.
I think so too. They're transparent, they know their stuff, and they take a personalized approach. It's a winning combination.
Couldn't agree more.
Well, I feel a lot more informed after this deep dive. Even a bit excited about fixed income now.
Me too. It's fascinating how Gilt Investments connects the dots between global events, market trends, and individual strategies.
They make it all come together, and they do it in a way that's both informative and engaging, especially with their focus on specific sectors and themes, like their bullish view on those renewable energy bonds.
Yes. Gives investors a clear framework for understanding where the real opportunities are. And that's what it's all about, right? Making informed decisions that will help you achieve your financial goals.
Couldn't have said it better myself. So to all our listeners, if you're ready to explore Australian fixed income, definitely check out Gilt Investments. Their weekly Edge report is a great starting point, and their team of experts is ready to help.
Don't let fixed income investing intimidate you. With the right knowledge and support, it can be a really rewarding journey.
That's a great point. Well, that's all the time we have for today's deep dive. Hope you found it insightful. And as always, keep exploring and learning. Until next time, happy investing.